Discover a step-by-step approach to selecting and managing dividend growth stocks that can provide increasing income year after year. Before we start, remember, this is not financial advice. Always do your own research before investing. Why does building a bulletproof dividend growth portfolio matter? Simply put, it's one of the most reliable ways to create wealth and achieve financial independence over time. Instead of guessing which stocks will soar next, you focus on companies that pay you to own them. These companies reward shareholders with regular growing dividends, often regardless of whether the stock market is up or down. Dividends can become a steady source of income, especially as you approach retirement. And if you reinvest those dividends, your returns can compound, accelerating your wealth even faster. But not all dividend stocks are created equal, and building a strong portfolio takes more than picking the highest yield you see. Let's break down a step-by-step approach to building a resilient long-term dividend growth portfolio. First, let's talk about the foundation. What makes a great dividend growth stock? A dividend growth stock is a company that not only pays dividends, but increases those dividend payments regularly, year after year. Companies like Johnson & Johnson, Procter & Gamble, and Coca-Cola have raised their dividends for decades. These companies are often called dividend aristocrats or dividend kings, because of their long track record of annual increases. Why is this important? Because a growing dividend helps your income keep up with inflation. It's not just about the dollars you receive today. It's about earning more each year, even as prices rise. But how do you find these companies? There are a few key things to look for. First is the dividend yield. Simply put, dividend yield is the annual dividend divided by the stock price, shown as a percentage. For example, if a company pays $2 per share each year and the stock trades at $40, the yield is 5%. A higher yield can look attractive, but be careful. Sometimes, a very high yield signals that the stock price has dropped for a reason. Maybe the business is in trouble and the dividend could be cut. For most investors, a yield between 2 and 5% strikes a good balance. Next, look at the payout ratio. This is the percentage of earnings that goes to paying dividends. A lower payout ratio, say 40 to 60%, means the company is keeping enough profits to reinvest and grow. A high payout ratio, like 80 or 90%, can be a warning sign. If business slows down, the company might have to cut the dividend. Let's use an example. PepsiCo. Over the last decade, PepsiCo's dividend yield has hovered between 2.5 and 3%. Its payout ratio is usually around 65%. That means the company pays a solid dividend, but also keeps enough earnings to invest in future growth. PepsiCo has increased its dividend every year for nearly half a century. Another key factor is dividend growth rate. This tells you how quickly a company is raising its dividends. A company that increases its dividend by 5 or 7% each year can double your income in about 10 years. Look for companies with a track record of steady dividend growth. For example, consider Lowe's. Over the past decade, Lowe's has grown its dividend by about 17% per year. That's an impressive pace, and it shows management's commitment to rewarding shareholders. Now, let's discuss diversification, one of the most important principles in investing. Diversification means spreading your investments across different companies, sectors, and even countries. This helps protect your portfolio if one company or industry faces tough times. For a dividend growth portfolio, aim to own stocks from various sectors like consumer goods, healthcare, technology, industrials, and utilities. Let's build a sample portfolio to illustrate. You might start with Johnson & Johnson in healthcare, PepsiCo in consumer staples, Microsoft in technology, Realty Income in real estate, Union Pacific in industrials, NextEra Energy in utilities. By holding stocks from different industries, you reduce the risk that a problem in one sector will hurt your entire portfolio. Keep in mind, you don't need dozens of stocks to be diversified. Even 10 to 15 well-chosen companies can provide solid diversification for most investors. Next, think about quality. It's not enough for a company to pay a dividend today. You want it to have a strong business that can weather tough times. Look for companies with consistent profits over many years, healthy balance sheets with manageable debt, a competitive advantage like a strong brand or unique technology. Let's take Procter & Gamble as an example. This company has been around for nearly 200 years and sells products people use every day, like toothpaste and laundry detergent. Its brands are household names, and it has increased its dividend for over 65 years. That's the kind of stability you want in a dividend growth portfolio. Another key point: pay attention to valuation. Even the best companies can be poor investments if you overpay. One simple way to check valuation is to look at the price-to-earnings ratio, or PE ratio. This shows how much investors are paying for each dollar of profit. Compare a company's current PE ratio to its own history and to similar companies. If it looks unusually high, it might be wise to wait for a better price. Now, let's talk about managing your portfolio over time. Dividend investing is not a set-it-and-forget-it strategy. Review your holdings at least once or twice a year. Make sure the companies are still performing well, growing earnings, and raising dividends. If a company cuts its dividend or its business declines, it might be time to consider selling. One useful habit is to reinvest your dividends, especially when you're still building your portfolio. Many brokerages offer a dividend reinvestment plan, or DRIP, which automatically uses your dividends to buy more shares. This can accelerate your wealth through the power of compounding. Here's a quick example. Suppose you invest $10,000 in a group of dividend growth stocks with an average yield of 3%, and they increase their dividends by 6% per year. If you reinvest those dividends, your income and portfolio value can grow surprisingly fast over time, potentially doubling your annual dividend income in about 12 years. What about taxes? In many countries, qualified dividends are taxed at a lower rate than regular income, making them a tax-efficient way to invest. But always check the rules for your own situation. Finally, remember to stay patient and focus on the long term. Dividend growth investing works best over years and decades, not months. Ignore short-term market swings and keep your eyes on the bigger picture, building a stream of growing income that can support your financial goals. Let's quickly recap the main steps. Choose companies with a track record of paying and growing dividends. Look for a reasonable yield, not just the highest. Check payout ratios and dividend growth rates. Diversify across multiple sectors. Focus on high-quality businesses with strong financials. Pay attention to valuation. Monitor your portfolio regularly and reinvest dividends when possible. By following these steps, you can build a bulletproof dividend growth portfolio that stands the test of time. If you found this video helpful, please like, subscribe, and let us know in the comments what dividend stocks you're watching. Thanks for joining me, and happy investing.